The last 5 years, right before you enter retirement, can literally double your savings. And in this video, I will show you exactly how to do that. Now, if you're in your 50s or your 60s, you're in this golden opportunity that you never really had before. And I consider it as your power zone. And why I say that is because three things. One, you are probably at your highest income level that you've ever been in. Second, you're at this age where many of your expenses are actually completed. Any of those loans are done. So you have this huge opportunity to redirect that money back to you. And third, if you're looking at the horizon, you have this huge opportunity of foresight to see exactly what retirement is going to look like. And so you can re strategize anything that you need right before you enter those years. So in this video, I'm going to show you hypothetically, let's say that you saved 400,000. So let's grow that so that every dollar works a little bit harder for you and puts you in this space of financial freedom and this opportunity to really enjoy retirement the way that you envision. So in this example, I'm going to hypothetically say that you saved 400,000. Now, you don't have to earn more. You don't need to work harder. You just need to understand how to do the math. So we're starting at 400,000. Let's say that you're contributing about 40,000 a year for the next 5 years. Well, typical growth of your investment portfolio is, let's say, a conservative 7%. Sometimes I've seen 10 to 12, but in this video, I'm just going to show you the math. We do compounded interest rate about 7%. So in 5 years, if you were to stay on that path, you naturally would end your fifth year at about 800,000. 791,000 to be exact. But again, you're just contributing 40,000 at 7% compound interest. Take out a compound interest calculator and you can literally see you doubled your savings. Now, where did you get that 40,000? Okay, I just said you don't have to work more. You don't have to work harder. No, 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 no. We're going to take a look at exactly where you're at. So if you're in your 50s and your 60s, there's good likelihood that you may have paid off your mortgage, for example. So suddenly all those mortgage payments that you're giving to the bank, take that money and redirect it back to yourself. Put that into your own savings and investments. Maybe you have grown kids and you're no longer supporting them through school or whatever type of expenses that you have associated with your children that they can support themselves. Okay, take that money and put that back to you. Start paying yourself. Maybe you have other personal loans. Maybe you have a car loan that you're finally done and over with. Start getting the picture. So any of these liabilities, they're done with. So all of that money that you're giving to someone or something else, redirect that money back to you. And if you do the math, let's say that you have a mortgage payment that is about, let's say 3,000. Okay, 3,000 times 12, that will get you really close to about 40,000 a year. So in this strategy, we're not talking about working more to get that money. We're talking about redirecting that money. Now, the next thing that you need to know about this mindset is you are also have this foresight that you're looking at your retirement years, and you know very well every dollar that you have that you already paid taxes on and you don't have to pay taxes in the future. Okay, that dollar in the future is going to go a lot longer. That is valued more, it's worth more, and can afford you more. And therefore, if you're approaching retirement, then in about 5 years, you have this runway where you can re-strategize and look at all of the different types of tax advantages accounts and start conversions. Okay, maybe you have a Roth IRA, which actually you should anyway, so you can take that money and start converting into your Roth IRA. I work in cash value life insurance policies as well as annuities. So I often suggest, okay, you might want to consider a non-qualified indexed annuity that offers you guaranteed income. If you do not have a pension, an annuity is not a bad idea. It operates similarly. Now, if you have a cash value life insurance policy, if you put money into that, you have two numbers. There's going to be the death benefit, which grows, and that's the money that gets passed on to your beneficiaries. But you also have a cash value component that grows just like a high index or high interest yield savings account. You might want to put some money into that and start funding that as well. Now, I'm not talking about moving and converting all of your money into these accounts. What I am saying is use this opportunity to take a look exactly where you're at, take a look at your runway, and you might want to start taking those funds and further diversifying your funds into tax advantages accounts. So now that you establish, okay, you know exactly where you're at. You also know the additional income that you're suddenly going to have. There's going to be this influx of money, and then you know all the different strategies that by the time that you retire, you can be at a lower tax bracket. In the financial world, we always anticipate that by the time that you retire, you will most likely be in a higher income bracket. So therefore, it's really important that before you enter retirement, that you start strategizing so you are at a lower income bracket. I mean, you might be on fixed income. So, anyways, being on a lower income bracket is going to be really good for old people. Okay. So, anyways, the third step, you're doing all of this strategizing. You want to make sure that your whole strategy doesn't fall apart, right? So you want to look at guaranteed sources of income and different ways that you can ensure this entire ecosystem that is your investment portfolio. So if you have all these different strategies, you want to make sure that you have at least 7 sources of income. So I can't stress enough that if you do not have a cash value life insurance policy, that is awesome for emergencies. It's not an investment, it is an insurance policy. So, again, going to that cash value life insurance policy and you have that cash value component in the case you have an emergency. Then you can tap into that policy and borrow against the policy to pay for emergencies. And obviously, in the case that you pass away, your beneficiaries have that death benefit also. So, that is going to be one way that you could ensure there's going to be extra money available to you in the case that, let's say, your liquid funds in your emergency account, in your savings account, hopefully you have about like 3 to 6 months, right? That's going to be the general rule of thumb. If that dries up, you have another source of emergency funds. Now, as I said before, if you don't have a pension, you might want to opt for an annuity. Annuities are not a bad idea. Now, they are not an investment. They are a financial product that operates similarly to a pension, whose whole premise is to offer you guaranteed income during your retirement years. I will tell you this. I know with the clients that I work with, they rest a little bit easier. They operate just a little bit more relaxed, knowing that, okay, among their 7 sources of income, if one source of income falls or is market dependent and there's a recession and suddenly those funds dry up or they fall, or for some reason they cannot pull out the RMDs or whatever, they can fall back on an annuity knowing that there's at least some type of foundation when it comes to their income. So it's not a bad idea to further diversify your entire investment portfolio with investment accounts that grow at a certain rate. They're invested into the market, a little bit more volatile, but also complement those investments with insurance products like cash value life insurance policies or annuities. Now, all of that said, I can break everything down into these 5 steps. You might want to write this down. Year one, you want to do an assessment of yourself. Map out every single account, map out your numbers, including the interest rate, map out any of your liabilities, write down all of your assets, and get real with the numbers that you have available to you. It may take a while, but you want to make sure you know exactly. It's nothing about feelings. It's exactly math. So where are we in terms of your own numbers? Number 2, once you have that transparency, now start getting real with when are those liabilities going to be done? Are you going to be done? Can you decrease those payments? Can you push those payments off to someone else? I don't know. But you want to get real with the opportunity that you can redirect those funds you were giving to someone or something else. You can go ahead and finally channel that money back to you in your own savings. So in year 2, start your strategy to redirect money back to you and start paying yourself. Number 3, you are looking at your runway, right? So you're going to be taking a look at your potential income tax bracket. And with that said, now is going to be the opportunity to look at tax advantageous strategies. What are the type of accounts that is going to save you on taxes? Take a look at that in year 3. Number 4, lock in your income streams. So yes, you do have this influx, and yes, you're going to be saving in taxes, but this whole ecosystem, this whole investment portfolio, and this strategy, you're not doing it for nothing. You're working hard on this. So you want to ensure it and make sure that you have guaranteed sources of income. In the case something happens, whatever emergencies happen, whatever life throws at you, you can always fall back on another source of income. And number five, right before you retire, is to test drive everything you've been working on. So maybe you spend a little bit more. Maybe you start buying the things that you've always wanted to do, or maybe you relocate, okay? Start implementing slowly the things that you have planned for retirement and start test driving the math that you have already mapped out beforehand, okay? Start looking at all those investments and hey, did all of the work that I did about 4 years ago, is it actually making sense and coming into fruition? So in year five, before you actually retire, consider it your test drive. Now, with this 5 year plan, really, I hope you understand that you don't need to earn more. You don't need to work harder. You just need an actual step by step guide that kind of maps out why in this power zone, how you can take advantage of all the opportunities that you have available to you and really take advantage of that compound interest and the decreased expenses and the opportunity that you have with the foresight that you have going into retirement. If you have any questions, go ahead and click the link below. I offer you a free guide on how you can achieve financial freedom.